This is Module 2. The economic growth rate and the implications of sustained growth. An economic growth rate is the percentage change in the value of all of the goods and services produced in a nation during a specific period of time as compared to an earlier period. The economic growth rate is used to measure the comparative health of an economy over time. The numbers are usually compiled and reported quarterly and annually. In most cases, the economic growth rate measures the change in a nation's gross domestic product, GDP. Tracking the ups and downs over a period of time shows direction and trends of economic growth. In the U.S. and most other nations, the economic growth rate is the change in the nation's gross domestic product. The economic growth is tracked over time as an indicator of the general direction of a nation's economy. Broadly speaking, increased demand leads to increased production and a higher economic growth rate. An increase in the economic growth rate is usually seen as a positive. If an economy shows 2 consecutive quarters of negative growth rates, the nation is officially in a recession. To put it baldly, if an economy shrinks by 2% from the previous year, its overall population has experienced a reduction in income of 2% in that year. Growth and decline are closely tied to the standard supply and demand models. If demand increases, so will production. Increased production means a growth in GDP. Technology is another factor that can increase production and therefore GDP. A contraction is when demand is decreased and production levels fall. An example is a company that had a net negative investment that had a capital stock of $24 million at the beginning of the year, and at the end of the year had a capital stock of $20 million. The economic growth trends in the United States and other countries and regions. Policy matters because policy impacts the economy in ways that are far-reaching. Increased regulations slow growth. Government targeting of industries such as fossil fuels increases the cost to produce and deliver goods and services. Outside of the COVID-19 pandemic lockdown, the growth rate in 2020 was 6%. 1 year later, the 2021 growth rate fell to 3.2% in 2022 and 2.7% in 2023. The government reported 2 consecutive quarters of negative growth. That is the definition of inflation. In 2022, global output contracted in the second quarter of this year, owing to downturns in China and Russia, while U.S. consumer spending undershot expectations. Several shocks have hit a world economy already weakened by the pandemic. Higher than expected inflation worldwide, especially in the United States and major European economies. The Federal Reserve raising interest rates to help stop inflation, while the administration pumps trillions of borrowed dollars into the economy, making inflation worse. Supply shortages with stable demand is also making inflation a major issue for most families. The October World Economic Outlook, WEO, largely reflecting forecast markdowns in the 2 largest economies. A revised assumption removing a Build Back Better fiscal policy package from the baseline, earlier withdrawal of monetary accommodation, and continued supply shortages produced a downward 1.2 percentage points revision for the United States. In China, pandemic-induced disruptions related to the zero-tolerance COVID-19 policy and protracted financial stress among property developers have induced a 0.8 percentage point downgrade. Global growth is expected to slow to 3.8% in 2023. What makes potential GDP growth? President Biden's $1.9 trillion stimulus to shore up the COVID-ravaged U.S. economy was ill-advised. There is still over $1 billion that is unspent from the last COVID relief package. One element of the debate compares the likely path of gross domestic product, GDP, to estimates of potential GDP. Gross domestic product is a measure of the value of all of the goods and services produced in the economy in a given period. It is calculated by the federal government's Bureau of Economic Analysis each quarter. Potential GDP is a theoretical construct, an estimate of the value of the output that the economy would have produced if labor and capital had been employed at their maximum sustainable rates, that is, rates that are consistent with steady growth and stable inflation. When an administration does not employ labor and capital at their maximum, you get a 40-year high inflation and lower production. The difference between the level of real GDP and potential GDP is known as the output gap. When the output gap is positive, when GDP is higher than potential, the economy is operating above its sustainable capacity and is likely to generate inflation. When GDP falls short of potential, the output gap is negative. Over time, an economy can grow without unwelcome inflation only as fast as its potential GDP grows. Think of this as the safe speed limit for economic growth. Too much government spending can produce a surge in demand that exceeds the economy's capacity to produce and triggers inflation. The sources of labor productivity growth. Productivity is broadly defined as the ratio of output to inputs. With respect to the economy, productivity measures how efficiently goods and services can be produced by comparing the amount of economic output with the number of inputs used to produce those goods. The term capital, as used in macroeconomics, refers to the plant, equipment, buildings, and inventories of raw materials and semi-finished goods. The two measures of economic productivity are labor productivity and multi-factor productivity. Both are produced by the Bureau of Labor Statistics, BLS. Labor productivity is defined as the ratio of real output per labor hour. The most commonly cited measure of labor productivity is for the non-farm business sector. For this sector, BLS looks at the changes between hours worked and goods produced. If workers the previous quarter were producing 100 goods per hour, and this quarter are producing 125 per hour, that is seen as growth. Multi-factor productivity, MFP, is an alternative measure of productivity that compares real private business sector output to the level of combined inputs, labor and capital, used to produce goods and services. BLS releases estimates of MFP annually. MFP, unlike labor productivity, differentiates among workers with respect to educational attainment and work experience. As productivity increases, society can produce more goods and services with the same level of resources, which, all else equal, increases incomes and access to goods and services, including additional leisure time. Growth in output per hour of labor can be achieved through three different sources: improvements in the quality of workers, increases in the level of physical capital, and technological progress. Human capital improvements in the abilities and efficiency of individual workers, often referred to as increases in human capital, allow each individual worker to produce more goods and services per hour, and therefore increase labor productivity. Increases in human capital generally result from increased education, work experience, on-the-job training, and so on. The theories of economic growth and policies. The principal theories of economic growth include mercantilism, wealth of a nation determined by the accumulation of gold and running trade surplus. The surplus can then be exported to acquire more gold. Classical theory. Adam Smith placed emphasis on the role of increasing returns to scale, economies of scale, specialization. With specialization, workers would become skilled at what they do and therefore produce more units per hour. Neoclassical theory. Growth based on supply-side factors such as labor productivity, size of the workforce, factor inputs. The neoclassical theory of economic growth suggests that increasing capital or labor leads to diminishing returns. Spending more capital will increase productivity only to a certain level before it starts to drop off. Endogenous growth theories. Rate of economic growth strongly influenced by human capital and rate of technological innovation. Workers with greater knowledge, education, and training can help to increase rates of technological advancement. Keynesian demand side. Keynes argued that aggregate demand could play a role in influencing economic growth in the short and medium term. Though most growth theories ignore the role of aggregate demand, some economists argue recessions can cause hysteresis effects and lower long-term economic growth. Limits to growth. From an environmental perspective, some argue in the very long-term economic growth will be constrained by resource degradation and global warming. This means that economic growth may come to an end. The flows of funds in financial markets. Flow of funds, FOF, are financial accounts that are used to track the net inflows and outflows of money to and from various sectors of a national economy. Macroeconomic data from flow of funds accounts are collected and analyzed by a country's central bank. In the United States, this data is released by the Federal Reserve Bank approximately 10 weeks after the end of each quarter. Flow of funds, FOF, are national financial accounts that track the movement of money among industries or sectors of the economy. Figures measuring the sale and scope of flow of funds in a nation's economy are collected and disseminated by the Central Bank for the Economic Analysis. This FOF analysis can then be used to measure economic activity and predict changes in GDP. They can also be used to help inform fiscal and monetary policy. The FOF accounts are used as a measure of economic performance. It is also used to formulate monetary policy. The Fed issues reports on the financial accounts of the U.S. that shows the assets and liabilities of each sector of the economy at the end of the period in question. It shows how each sector used the funds and where it shifted. It also looks at funds that have moved in and out of the economy. Fund flow doesn't measure the performance of any asset. For example, with mutual funds, fund flow measures the cash involved in share purchases, or inflows, and the cash resulting from share redemptions, or outflows. It doesn't say anything about how well or how badly a fund performed. Fund flows are a reflection of cash that is flowing in and out of financial assets. Investors can look at the direction of the cash flows for insights about the health of specific stocks and sectors or the overall market. Mutual fund or ETF fund managers with net inflow have more cash to invest, and demand for the underlying assets tend to rise. With net outflows, the opposite is true. High net inflow may reflect growing overall investor optimism. High net outflow may suggest increasing investor wariness. Function of money. The following are a function of money: a unit of account, a medium of exchange, and a store of value. This is different than bartering. Bartering is the exchange of goods and services directly for other goods and services. Money is a store of value. If I work today and earn $25, I can hold on to the money before I spend it because it will hold its value until tomorrow, next week, or even next year. In fact, holding money is a more effective way of storing value than holding other items of value such as corn, which might rot. Although it is an efficient store of value, money is not a perfect store of value. Inflation slowly erodes the purchasing power of money over time. Money is a unit of account. You can think of money as a yardstick to measure value in economic transactions. If you are shopping for a new computer, the price could be quoted in terms of t-shirts, bicycles, or corn. So for instance, your new computer might cost you 100 to 150 bushels of corn at today's prices. But you would find it most helpful if the price were set in terms of money, because it is a common measure of value across the economy. An example of a unit of account is a $25,000 price tag on a new car. Money is a medium of exchange. This means that money is widely accepted as a method of payment. When I go to the grocery store, I am confident that the cashier will accept my payment of money. In fact, U.S. paper money carries this statement: "This note is legal tender for all debts, public and private." This means that the U.S. government protects my right to pay with U.S. dollars. How saving and investment decisions interact in financial markets. Financial markets refer broadly to any marketplace where the trading of securities occurs, including the stock market, bond market, forex market, and derivatives market, among others. Financial markets are vital to the smooth operation of capitalist economies. Financial markets refer broadly to any marketplace where the trading of securities occurs. There are many kinds of financial markets, including but not limited to forex, money, stock, and bond markets. These markets may include assets or securities that are either listed or regulated exchanges or else trade over the counter, OTC. Financial markets trade in all types of securities and are critical to the smooth operation of a capitalist society. When financial markets fail, economic disruption, including recession and unemployment, can result. The markets function as places where the orderly exchange of financial instruments occurs. Public companies seek investment by exchanging shares in their company, and investors look for opportunities to grow their wealth. Saving equals disposable income minus consumption expenditure. The stock market is just one type of financial market. Financial markets are made by buying and selling numerous types of financial instruments, including equities, bonds, currencies, and derivatives. The market is supervised by the Securities and Exchange Commission, SEC, that ensure transparency of company information and accurate reporting. Typical participants in a stock market include both retail and institutional investors and traders, as well as market makers, MMs, and specialists who maintain liquidity and provide two-sided markets. Brokers are third parties that facilitate trades between buyers and sellers, but who do not take an actual position in a stock. How government influence financial markets. Governments use spending and taxing powers to promote stable and sustainable growth. If the government prints too much money, it leads to inflation and higher debt. Inflation leads to a raising of the interest rates to help slow inflation by taking money out of the market. The balance between keeping rates low to encourage growth and raising them to slow inflation is delicate. When policymakers seek to influence the economy, they have two main tools at their disposal: monetary policy and fiscal policy. Central banks indirectly target activity by influencing the money supply through adjustments to interest rates, bank reserve requirements, and the purchase and sale of government securities and foreign exchange. Governments influence the economy by changing the level and types of taxes, the extent and composition of spending, and the degree and form of borrowing. When consumer confidence is low, people hold on to their assets and do not spend as freely. As a result, the demand for products is reduced. When demand is reduced, production is slowed. This is a reaction to the GDP, and growth is either stagnant or negative. 2 consecutive quarters of negative growth is a recession. If consumer confidence and therefore spending does not change, the government can initiate a stimulus package to encourage consumers to spend. The government sends direct payment to the citizens in hopes they will spend it on goods and jumpstart the economy. This, of course, increases the public debt as the money for a stimulus package has to be borrowed. As of April 2023, the U.S. government has borrowed $31.6 trillion. Each American taxpayer owes $294,000 to pay the debt. If we paid $1 a second on the debt, it would take 1,000,000 years to pay off the principal only. Fiscal deficits and public debt ratios, the ratio of debt to GDP, have expanded sharply in many countries because of the effects of the COVID crisis on GDP and tax revenues, as well as the cost of the fiscal response to the crisis. Support and guarantees to financial and industrial sectors have added to concerns about the financial health of governments. Many countries can afford to run moderate fiscal deficits for extended periods, with domestic and international financial markets and international and bilateral partners convinced of their ability to meet present and future obligations.